I want to go a little bit more into this Mark Ritchie Trading Bible book I just finished, and excuse me, and a little bit about risk management for the regular mechanical systems trader, which honestly I don't know a whole lot about because I don't do that, but potentially how that might work. And for someone who's very systematic in their approach, very methodical, mapping things out, and someone who trades more like I do, who it's more intuitive, more discretionary, maybe right-brained a little bit more sometimes, thinking about other traders being stuck, thinking about sentiment and positioning and things like that, violation of levels, all these different things. And, I talked to a friend about this. I wish I would have just sent over the message that I gave him as a podcast, but I'm going to try to recreate it here. And when I was reading that book, I found myself reflecting on how can I do things better and could I manage my risk? Of course, I could manage my risk a little bit better. I'm sure everybody could. And I've made it work, though. I've made it work for me. And it's not an exact system. It's an artistic system, just like the upside is for me. And sometimes when I'm trading in the short term during the day, I would have a very small amount that I'd be willing to lose. And when I was working prop trade in Chicago, trading futures, we had a risk manager who would shut us off if we hit a certain limit for the day. And this is very helpful because it would be irritating, but it would be helpful at the end of the year. You wouldn't have a runaway losing day because you would just get shut down. And they would move that limit around if you were doing better or doing worse. And if the volatility was going up and your days and swings were bigger, you would obviously adapt your how much you can lose to that. And if it's slow and nothing's happening, then you'd only be willing to lose less. So that was really useful, like having a third party to help with the risk. But most of us don't have that. I don't have that anymore either. So I guess the big question for this podcast is, how does a flow trader or an intuitive trader, discretionary trader manage risk versus someone who's very systematic and very mapped out in what they're going to do? And the guy in the book talks about he had many different systems and he'd be risking a small amount for each system. He mentions 0.5% of equity, but he has something kind of like the Kelly criterion. If you've read about that, he has his own version of bet very small and stay in the game a long time, because if you bet small, you'll be able to ride out a statistically probable set of events where you lose a lot of trades, and it's just a normal distribution. And that makes total sense on paper. And for me, though, for my trading, it hasn't really worked that way, because when things swirl together and there's a confluence of sentiment or whatever I see technically, or I think people are stuck in something or whatever happens, I want to bet way bigger because I've seen that. And I think I feel like I've tapped into the moment of flow where I understand what's going on. And it's a really big thing for me. And I've traded up to 10 times bigger sometimes in those types of situations. And it takes time to and I don't always succeed on that, but it takes time. I usually am right, though, when I do that. And it's because I've gone through so many of these setups over and over again, and I know what would work for me for that. And usually, though, when I have one of those moments, it's preceded by a lot of small trading with small losses, and all of a sudden I just feel like I got this. Like maybe I get stuck in something, I realize everyone else is stuck at the same time, and it kind of sets up a situation where I'm like, I see it. I see what's happening here. Or it's, some news that nobody expected or whatever sets something up, or whatever it could be. And it's hard for me to quantify that. It's hard for me to say, I need to risk, whatever percent. It doesn't work that way for me. I do cut my size down when I'm struggling. So I get very beaten down when I'm not doing well, and I'll kind of crawl into a hole and trade smaller, or I'll just take a break and I'll trade less. So that's been a really good survival mechanism for me to use. And I don't know, sometimes I don't know if everything a lot of this is open to interpretation, and the trader's personality has a big part in this. So I'm not saying I'm exactly right on all this at all. I don't think that, but let's compare it to a sport. Defense wins championships, we always hear. Well, sometimes, but not always. Sometimes offense wins championships. Sometimes a average defense with a really good offense wins the Super Bowl. Because you score a shitload of points and you give up just enough that it doesn't matter. You win the game 60-35. Hey, great, you still won the championship. And sometimes the defense, holds you in the game, and the offense isn't as good, but it doesn't matter. So defense would be risk management. I think that ultimately risk management is probably the most important thing. And I agree with him in the book saying that basically most traders lose because they trade too big. That's the bottom line. That's the main takeaway of the whole book. And I've found that when I've struggled more than I would like to, it's because I'm trading too big, either after losing or getting sloppy and trying an idea 2 or 3 times and trading way too big. And then maybe it works out the 4th time and I have a lot of losers and I'm thinking I really hurt myself. So I think just playing small ball and staying smaller than you would like often leads for you to trade bigger when you least expect it, because you kind of feel things out. And that's what I say when I feel like I'm in the flow. I just feel like I feel something, I see something. And that can be different time frames, but you just dial into something according to your strategy. And it's almost like that's the intuition part. And you have to kind of work your way there by doing a lot of trades. But once you get to something like that, it's hard for you to define to somebody like, oh, I use the Kelly criterion for all my trades. I like to put on, I risk 0.01% of my equity. This is not what I do. It doesn't never worked for me. I've tried that stuff and it's not been useful at all for how I trade. I don't think it's stupid for other people. That's not what I'm saying. But you can, when you're struggling, you can start to box yourself into these ideas and think that you need to redo everything. And it's never a bad idea to trade smaller when you're struggling. It's absolutely important. But from my experience in my career, my biggest money has been made in moments. So it could be days, and it could be weeks, or it could be periods of months where I really see something depending on my time frame, and I hit it really hard, and I trade way larger, and I make many multiples of money in that period, and then it kind of resets to something that maybe I don't understand or I'm not as good at, and then I'm getting hurt a little bit, or I'm trying to just take a break and stay out, and I need to limit those periods. So that's kind of my risk management system. Another thing that's a risk management system for me is I've set my life up where I don't trade with my whole net worth. I don't trade with all my money. I have plenty of money in other things that can't really be hurt by trading. So in some sense, there's a blunt mechanism for risk management built into the way I live. And that takes time to build up to that, but I've done that. So, I've never blown out an account. I mean, maybe in the beginning for a small amount, but I've never really legitimately gotten in trouble with a lot of money. And I've done some really bad stuff, and I've had huge losers, but I've always been able to kind of hold it together that way. And even if I wouldn't do that, I'm not going to go and change my entire lifestyle. My trading account is not all there is, but it is something that not everyone has the same situation. I've had to work towards that and build that for myself. So that's another risk management thing that I have built in. I guess the big message though is that you want to be able to trade bigger, and you want to be able to use more of your money. But sometimes using less of your money and trading smaller is the way to what you want. It just doesn't always feel good. And I'm still going through that. Everyone goes through that. You want to bet bigger when you really understand something. But taking less losers for me especially, and I think everyone's like this probably, but I can be kind of offensive trading wise, and defensively I can get maybe a little sloppy sometimes. And because I really kind of overdo it when I'm doing well, and then it's pretty extreme for me that way. I'm not really a grinder, more of explosive stretches. So when it's not going well, to really scale that back quickly and just take a break. And then it's funny when I go to that spot where I'm feeling like, you almost feel beat up when you take a break. Sometimes I do. Like, geez, am I ever going to see something I like again? I don't understand this market right now. And then lo and behold, that's a good place to be. And something happens and you start trading it smaller, and all of a sudden you start seeing it, and you just naturally will trade it bigger. And then, you go on a good run and it resets again. So I think just some thought should be given to how you are. You can't lie to yourself. You can't build something that's not you. If you are more disciplined, systematic, mechanical, I have lots of people use I risk 2R to make 3R, all that. I did all that stuff, like Van Thorpe trading for a living. I've done all that stuff and tried pretty much everything you can think of. It just doesn't work for me. It's not the way I look at things. I would keep saying I'm risking 1R, if you guys know what that stuff means. And I would just be making up arbitrary risk parameters that would just keep getting hit, stopped out. And it's like, well, I could just throw any stupid number down, but I'm just making bad trades. And I say that I'm only risking 1 unit, but it doesn't work that way. I'm trading too big. The units are too big. It's just trading size is everything. It doesn't matter how much you lose, or even if you make a big slip on something, if you're trading a reasonable size, you continually recover from that. And mentally, not just financially, mentally and emotionally too. So his main point in his book's a really good one. I just happen to probably look at the market and do things a little differently. So that's kind of what I want to share today.